Now let me introduce on the show Devang Shah of Axis Mutual Fund to talk about the RBI monetary policy outcome. Devang, hi, and thank you so much for taking our time today on the show. So it's obvious that once again, interest rates continue to be very low for India. That's been the case around the world as well. But I think what we are seeing is also a sign that perhaps interest rates will stay lower for longer, Devang, because the RBI has said that, look, we are going to focus on growth. If growth has to come, then interest rates will probably have to stay lower for longer. What's your sense overall from a debt fund holder point of view of what stood out from the governor's speech today?
So yes, I completely agree that today monetary policy RBI has been status quo on rates, and this is probably the seventh monetary policy where RBI has not changed anything on rates. If you look at the commentary also from the governor, it is very focused on growth, and at this point of time, the entire ammunition which RBI has on its own balance sheet, they are using it for the growth cycle. I think somewhere down the line, if you look across at the overall thought process from RBI, they have made some changes specifically to announcing VRR, which is the variable reverse rate repo auctions, where from the 2 lakh crore fortnightly auctions, they have increased it in a phased manner to 4 lakh crores. I think somewhere down the line, RBI started thinking that yes, growth is something which needs prior importance, but today's macro environment, looking at growth, looking at inflation, they've also actually increased the inflation expectation. They've moved up from 510, 520 to now 570. So looking at both macro variables, which is growth and inflation, I think somewhere down the line, post the vaccination drive, post all the high frequency indicators, looking at how the heat map is working across, I think RBI has started somewhat normalization of monetary policy, though they have been very, I would say, dovish and continue to be accommodative. But the change or the change in the VRR for personally, I believe that RBI started looking at normalization in a slow and steady manner. Rates are going to stay low, so they are not that RBI will be in any hurry to hike repo rates. In fact, the normalization process also, as we have been speaking time and again, I think it will be through a three-way process where first they will absorb all the liquidity into the system. Secondly, then narrow the corridor between reverse repo and repo, which is today 65 basis. The reverse repo is at 335. The repo is at 4%. I think the corridor will get narrowed to 25 basis, and then probably we are looking at repo rate hikes. So I think this is the first move, even though not communicated by RBI. This is the first move towards normalization, and rates from here on, I think, should not see any rally. They would inch upwards, but it would be a slow and very gradual move.
Okay, so not a rally, but a very slow and gradual move. How does this bode, pardon me, for bond prices then, Devang?
So our understanding today, actually, after the policy, if you've looked at the reaction on the long bonds as well on the short bonds have moved up by approximately 5 to 10 basis, and the long bonds have sold off by another 5 odd basis. So movement across the bond markets on yields have gone up. Just to again explain the relationship in bond markets, the yields go up, the prices go down. They are inversely correlated. So we have seen some bit of sell-off in our markets. As I explained to you, that markets were not expecting the VRR to be announced in this policy. RBI continues to remain growth focused. RBI continues to remain accommodative. But I think the introduction of VRR again from 2 lakhs to 4 lakhs, as well as a dissent from one of the MPC members, I think is slightly taken as negative. And our belief is that over the next 2 to 3 months, RBI will continue with this slow and gradual normalization process. And hence, for bond markets, the levels, the yields should start inching up slowly and gradually. Obviously, on an inverse relationship perspective, the prices of bonds will go down.
What's your view, on inflation? The governor has said that, look, this is just transitory, something that even the Fed had spoken about, that, look, we are clearly just having problems on the supply front, and because there's not enough supply, prices of essential things and commodities, like we saw vegetable oil prices, pulses, etc., was going up. So we are seeing inflation. The CPI, which essentially represents inflation in the country, as well inched up in these last 3 to 4 months. So what's your view? And also, do you think how can rather fixed income funds help today a retail investor protect purchasing power given the current inflation that we are seeing?
Right. So I think if you ask us what is our CPI reading, so I keep aside the noise on the couple of prints which have gone above 6%. The medium term inflation for us also is very much similar to RBI. In fact, prior to RBI revision on CPI, our expectation on the CPI headline or for the year average for the year was closer to 570. Our belief is that if I look at the internals, core inflation continues to remain sticky. There is volatility on food prices, and I think somewhere down the line in the next 12 months or so, we might see some service inflation getting passed on, which will again have some impact on the core side. So inflation on a medium term remains sticky. With a repo rate at 4%, I think the real rates in India are negative, and hence it is very, very important from an investor perspective to actually, as you rightly said, to protect investor returns is the most important criteria for us at this point of time. What then, from a fixed income basket perspective, what should an investor look at in a rising interest rate environment, as well as at a significant, you are at the lowest point on the fixed income curve, as well as on the cycle? I think our understanding is investors at this point of time should park their money in ultra short term, low duration strategies, which are having very, very significant low duration and should not see significant volatility when rise in rates. These are some products which probably at the yield of 5 odd percent would try and meet investors, I would say, or try can meet the inflation expectations which are there in the economy.
The governor also announced more GSAPs, that whole VRR bit as well that you two alluded to, and they said that this is all around managing liquidity. How had you seen, what sort of response had you seen to the previous auctions put forward by the RBI, and what do they usually do in terms of an impact on yields when the government sort of announces these auctions and they go through?
Sure. So see, the GSAP, they have for the next two auctions, they have increased the amount probably from 20 to 25,000 odd crores. But I think the overall amount of GSAP for the quarter was announced at 1,20,000 and it continues to remain at the same level. So from a GSEC acquisition plan, there's been just a preponement. I don't see an absolute increase in the amount of the GSEC acquisition plan. How does it work? It is a kind of an open market operation where RBI is buying bonds. They have specified they buy off the run, on the run securities of various tenors, and this actually helps one to keep the yields protected. This, and we have had a large borrowing program announced this year thanks to the fiscal deficit being higher in the budget. I think the GSEP plan, the GSEP borrowing program does help RBI as well as government to manage the yields as well as sail through the entire borrowing program. So that is on the government acquisition plan. On the VRR, today, if I look across at the banking liquidity is upward of 8 lakh crores. The durable liquidity is around 10 lakh crores. Now, these kind of liquidity in India we have never witnessed in the last 15 odd years. Why this liquidity? One, it was COVID. RBI wanted to ensure that we don't see any kind of shocks and the credit flow continues to the economy. From 2 lakh crores, if the variable reverse repo goes to 4 lakh crores, I think first of all, with abundant liquidity of 8 lakh crores, do we see any kind of major impact there? Our view is no. We will see a lot of success in this auctions, and probably our understanding is the tenor of these auctions also would be 14 days. And hence we don't see any kind of huge impact or any kind of failure on these auctions. Banking liquidity is huge. We will see a good success ratio from RBI's perspective. The impact of this, I think the VRR auction is not something which we should get too worried about, because it is 4 lakh crores to the banking liquidity to the tune of 8 to 10 lakh crores as explained before. It is more about that RBI is slowly and steadily moving towards normalization. We have had rates at its bottom. This is the time probably when investors should start thinking that the interest rate cycle is nearing its end, and hence for investing as well as looking at solutions from fixed income perspective, at this point of time they should park all their money in the extreme short end of the curve.
All right. So all of these, announcements made by the RBI, an indication that we perhaps may be moving towards a normalization, and that the interest rate cycle may be nearing its end. In such a situation, it makes sense that investors park their money in ultra short-term and low-duration funds. Devang, I just want to look at individual yields, and there's a very interesting report where I read that corporate yields have risen in the last 6 months. In this last 1 month, the 1-year GSEC yield has fallen while the 10-year one has increased. So let's talk about corporate yields first. You're seeing an increase in the yields. What's your view then, and what's the impact on one particular fund, and that's the corporate bond fund that's there to particularly take advantage of investing in loans by corporates? What happens when corporate bond yields rise, as they have been in the last 1 year and 6 months, to corporate bond funds?
Sure. So see, I think corporate bond yields had if you look at actually the last 1 year or 18 months, I think corporate bond yields have actually fallen, because since April 2020, once on the onset of the pandemic, I think the 2-year, 3-year, 10-year corporate bonds were at significantly higher level from current levels. Most of the rally happened in the first 6 to 7 months, and since September, October 2020, I think markets have remained quite flat, because we have not seen any action from RBI from a rates perspective. RBI had front-ended all the rate cuts, plus the liquidity infusion, which led to rally. Post that, I think probably markets have remained quite stable. They have inched up a bit. Corporate bond supply in India, thanks to, I would say, a couple of reasons. One is pandemic. We have had lower working capital requirements, as well as over the last 12 months or so, I think corporates have significantly worked on creating liquidity and improving the balance sheets and deleveraging. All this led to significant less supply on corporate bonds. Today, if I look at spreads, corporate bonds over government bonds, I find them significantly compressed. And on an overall perspective, I think corporate bonds incrementally don't make value from an investor perspective. Corporate bond funds, our view is, if you buy a corporate bond which is running a barbell strategy, and I'll explain you what do I mean by barbell, it still is attractive from an investment option. When we are talking about barbell strategy, what we believe so is that at this point of time, when we are at the cusp of the reversal cycle, most of the portfolio should be invested in extreme short bonds, and a part of the portfolio should be invested in long bonds, which are actually pricing in rate hikes and the supply pressure. If you are at the belly of the curve, which is the 2023-2026 segment, which is 3, 4, 5-year corporate bonds, somewhere down the line, not only the absolute levels, but the spreads out there are significantly compressed. And once the reversal cycle starts, I think this is a segment which can get maximum hit. So corporate bond funds is not a problem. It is probably the choice of corporate bond funds. There you need to focus on funds which are running barbell strategy, rather than picking up the traditional 3 to 4-year segment corporate bonds, which in the reversal cycle, as well as the liquidity absorption by RBI, would get the maximum hit.
All right. So choose corporate bond funds that adopt a barbell strategy, to put it simply. This is the recommendation coming in from Devang. Now, gilt funds, on the other hand, Devang, the 1-year gilt fund, interestingly, gilt funds have been a great category. For the last 3 years, investors have seen double-digit return. What is what's the sense you're getting on gilt funds going forward?
So see, it's our macro call is that it probably we are at the end of the rate cut cycle. We are not seeing any incremental rate cuts from here. In fact, the reversal is round the corner. So right. Gilt funds, accordingly, if you ask me, all of them have adjusted their duration, and where over the last 2-3 years, where gilt funds were running extreme long durations of 7 to 10 years, now they are probably running 3 to 4 years. Our thought process is, for an investor who is looking at a long-term solution from fixed income, gilt funds do offer good opportunities. But if you are investing today in a gilt fund, it should be an active gilt fund. It should be at the lower end of the duration. I don't see any problems from an investment perspective, and these should be medium-term investment horizon. They should not be short-term, because the short-term investment horizon is that you are actually looking at the reversal cycle, and any kind of duration will offer you volatility. But medium-term solutions, gilt continue to remain a good option. The last 3 years, just to give you a caveat there, last 3 years have been a downward interest rate cycle. We have seen massive slowdown in India, and not only India, I think across the globe, and that has actually led to an accommodative as well as a rate cutting cycle, which led to outperformance of gilt fund as well as double-digit returns. From here on, I think investors also need to get acknowledge the fact that the capital gains on account of interest rate cuts are behind us. So from here, it is more a carry as well as a low interest rate regime where probably the return expectation should be reset at the 4 to 5% band for the near term.
Okay, so maybe that double-digit return that we saw is now behind us, and from here on, in the near to medium term, we could be seeing returns of roughly about 4 to 5% when it comes to gilt funds. Clearly, Devang, your view is that if you have to put your money in debt funds, you should put it in ultra short duration funds or short duration funds. So right now, if somebody has long duration funds, this year has not been a great one for them. What would you recommend their strategy should be? Should they exit and perhaps park their money in the shorter duration funds?
So as explained, that unless and until the long duration fund is running when I look at most of our peers or the industry at large, I think most of the fund houses have significantly reduced duration. So even if you are investing in a corporate bond or a GSEC fund or government bond fund, I don't see it issue unless and until they are running ultra long strategies. So if the duration is upward of 5 or 7 years, I think somewhere down the line in the near term, it is better to probably switch out of those funds and look at options or alternatives which are holding lower duration.
Okay. All right. So, Devang, what I would like you to do now is just construct a debt fund portfolio for our viewers. I know you say short duration funds, but our viewers have 5-year horizons as well, 6-year horizon. Personal finance experts say that, okay, as your goal for which you're investing in mutual funds comes closer, you should move from equities into debt funds because they are less volatile and there is a little more certainty and guarantee of what the money you will get at the end of your period. So for those individuals who have a 4 to 5 year time horizon, a 3 to 4 year time horizon, for those individuals who don't want to take too much risk and hence are going for fixed income funds, would you still stick to short duration funds for them as well?
So what would I do is at this point of time is probably if I have 100 rupee of investment in debt, okay, and if I'm investing my personal money, okay, what would I advise is I would hold 30% in floating rate instruments, because floating rate bonds funds are actually, they get reset with every, so these are a category of low duration funds, floating rate funds, which get reset with every rate increases, because there you are holding either a floating rate instrument or a swap with, once the interest rate hike starts, automatically you start getting higher coupon and the MTM loss or the capital loss is significantly less. So 30% allocation in floating rate funds or low duration strategies. Secondly, investors who understand credit and who are okay with AA kind of allocations, I would invest 30 to 35% of my money in credit strategies, and the balance 25-30% I would invest in short-term funds or corporate debt strategies which are using barbell. So if I am deploying my $100 in debt, I would do a one third in low duration floating rate funds, one third in corporate debt short-term strategies using barbell, and one third in credit funds which are allocating to AA exposures.
Okay, great. So ultra short term or low duration funds, floating rate funds, which whose return sort of resets when the RBI announces their monetary policy. If they increase it, this will be the case for the floating rate fund as well. A credit risk fund, but mind you, here the credit quality will be a AA plus. And finally, corporate bond funds using a barbell strategy. That's essentially the kind of debt fund portfolio that Devang would construct for himself, and this is what he recommends to all of you interested in the debt fund category right now. Well, Devang, with that we're out of time, so we'll let you go. Thank you so much once again for joining us today on The Money Show.
Thank you.